Hello! Today we're going to talk with you and Alex about private placements, also called syndications or funds, and how tangible wealth solutions can help clients with reviewing, understanding, choosing, and investing in them. But before we get into the details, we need to share with you and Alex these important disclosures. A private placement or syndication is a structure or relationship between a company, called a sponsor, and multiple investors who pool their money to invest in real estate. The investors are passive, and the sponsor oversees buying, building, operating, and ultimately selling the property. These types of investments can include ground-up development of all property types, such as distribution centers, multifamily apartments, seniors housing, data centers, medical office. The repositioning or value add of existing properties. This includes rezoning former industrial sites in the urban core to high-density, multifamily, or mixed-use zoning. Buying vacant big-box retail properties and converting them into climate-controlled self-storage buildings. Also buying older multifamily properties and renovating, updating, or adding amenities to increase rents and occupancy. With private placements, Alex and other investors can invest in multiple projects by being a partial owner and lean on the expertise of the sponsor. Alex can also spread his risk out by investing in multiple private placements with different strategies, property types, and markets. To give you the full picture, let's first start with who sets up a private placement. The people or company that sets up a private placement are called sponsors. Good question. Private placement sponsors are real estate investment companies that set up the private placement. Sponsors typically have experience with a specific property type or strategy. As a sponsor raises capital, performs their strategy, and then sells, they develop a track record. When a sponsor wants to raise capital, one way is through a broker-dealer. The sponsor presents their deal to the broker-dealer, and the broker-dealer performs due diligence. The broker-dealer does a deep dive, looking at the sponsor at such things like the principles of the sponsor's background, time with the company, experience, and track record. How much of their own capital are they putting into the deal? The size and capabilities of their overall team, including operations. Understanding who their professional partners are that will be helping them execute their plan. If the broker-dealer cannot get comfortable with the sponsor, they will deny bringing the deal onto their platform. It's recommended that if you're not comfortable with the group you'll be entrusting with your money, there's no reason to go any further. After reviewing the sponsor, they'll then look at the structure of the investment. This will include looking at the following things: how much capital is being raised, what is the alignment of interest with the investors, what fees are being charged, when are they earned, and at what point are they paid, what does the waterfall or promote look like, what is the expected hold period, how and when is capital projected to be returned. After reviewing the structure, they'll then look at the specific investment, which will include, but is not limited to, the following: property type, what is the overall strategy, what are the sponsor's assumptions and are they reasonable, are the targeted markets appropriate for the targeted strategy, what is the downside. If approved, these private placements are placed on their platform for the registered reps to consider when looking at appropriate investments for their clients. Registered representatives hold the appropriate securities licenses for selling private placements to accredited investors and are a very important part of the process. This is where Tangible Wealth Solutions comes in. Through our relationship with Emerson Equity LLC, our registered personnel take on the responsibility of identifying which private placements or syndications we believe may be the best fit to meet your financial goals. Private placements vary in some of the following ways, making some a better fit than others based on each individual's goals and circumstance. The differences between them can include the hold period. Some funds may be as short-term as 1 to 2 years. Some may be between 3 and 5 years, with some being 6+ years. This comes down to liquidity. Some may have options to redeem shares or to sell during the hold period. Others may be restricted from early sales. And some may focus on providing immediate consistent cash flow, while others may provide no cash flow during the hold period with the intention that all of the returns will be paid out upon the end of the hold period, assuming the strategy was a success. Tax-efficient investing and pass-through losses such as depreciation may reduce the taxable income paid on income produced from the investment. Investing in private placements can create a lot of potential advantages, and the sponsor should be adding value in the following ways. Let's start with these 3 ways, then we can go into the rest the next time we get together. 1. Access to institutional quality real estate investments. Most real estate investors can't afford to buy multi-million-dollar properties. Private placements allow investors to acquire partial ownership in properties and strategies that would otherwise be out of their reach. 2. You have no management responsibilities. The private placements are managed by property management companies with a high level of expertise and experience managing specific types of properties. 3. Leverage, but not just in the form of debt, which when used within real estate investments can potentially amplify returns. The following are all areas of leverage that the passive investor may be able to benefit from when investing in private placements. Leveraging the sponsor's knowledge to find the right investment in the right place, execute and sell at the right time. Leveraging the sponsor's experienced team of professionals. Leveraging the sponsor's experience, contacts, and systems to source deals the investor couldn't do on their own. Leveraging the sponsor's financial strength and negotiating experience to obtain optimal financing terms. Leveraging the sponsor's time so the investor can spend their time doing what they're best at or prefer to do with their time. Leveraging the capital of other investors so that as a group, the investors can invest in deals larger than they could or would invest in on their own. In addition to the value that may be provided by the sponsor, another advantage for investing in private placements is Alex does not need to invest all of his cash that is allocated to real estate into just one private placement. It's much easier to invest in multiple private placements to get diversification. The time it takes to manage a portfolio of private placements is considerably less than the time it takes to manage a portfolio of directly owned real estate. You are smart to ask that, Alex. That's the kind of question we love. Transparency builds trust. You don't have as much control with private placements as you do with buying and owning real estate directly. Private placement will vary in expected hold period. Different structures can work really well for someone in one situation, but not in a different situation. If a private placement is an investment we both think is good to explore, we'll provide all the guidance you need to identify which private placements we believe works best for you. We thrive on helping people make the best choices for them and their future by providing clear, well-thought-out plans that recognize risk while seeking to increase the chances for financial success. It's not about buying and selling. It's about getting to know you, understanding your needs, and where you want to be financially today, tomorrow, and for the next 30 years. To learn more, call us at 720-439-6540 or visit tangiblewealthsolutions.com.